On today's hot sheet, I'm discussing CPI data just released this morning. Home price declines in 35% of markets. And Realtor.com's latest rental report. Today is Tuesday, August 12, 2025. I am Byron Lazine, and the hot sheet starts now. It's inflation day. We got inflation, fresh inflation data. There's going to be two big inflation data reports and two big job reports between the last FOMC meeting and the next one in September. There's also going to be the Jackson Hole Symposium for the FOMC members. All the members of the Fed get to go to Jackson Hole, probably talk about their big, beautiful $2.7 billion renovation and figure out if they're finally going to pull the trigger or not. But they're going to take in the data, of course, give them the benefit of the doubt. They'll be taking in all the data on this in today's inflation report, which is CPI. Remember, CPI is more for the markets. You're already seeing the markets move up off of this report, right? Wall Street likes what they saw today, and markets moving up this morning. We're already at a stock market that's at record highs, and it continues to inch up. We'll break it all down, what it means for housing, what it means for the potential next cut. Good to see a bunch of you guys over from the BAMX role play. If you want access to the members only role play, it's every Tuesday right before the hot sheet. Just go to school.com/BAMX to make sure that you jump into that. All right. So before we break down the actual CPI report, check out this headline. I mean, this is like a duh for me. I've been saying this for I feel like a couple of years now. Wall Street is concerned about the reliability of government inflation data on the eve of the CPI report. Okay. I mean, just think about all of the conversations we've had here on the hot sheet. If you're an OG hot sheet member, put OG in the chat for me. You know what I'm talking about. Owner's equivalent rent, one of the most silliest, made up, ridiculous, ways to measure housing inflation that there is. Back from the 80s, you're calling homeowners on their telephone, on their landline, and getting a feel for what they think their house would rent for if they had to go rent a similar house. It's stupid. It's dumb. It's made up. It's not from professionals. We have real-time data. We're gonna look at some of that from Realtor.com here before the end of the show. Okay, so this week's inflation data, it's obviously a big moment here as we continue to absorb in that job report, one of two big ones before the next meeting. And you've got concerns that are coming from Wall Street that, okay, you fired this BLS commissioner, is the Bureau of Labor Statistics going to be politicized? But there's other questions on other fronts, and that includes what this data, this inflation data looks like. Is it accurate? Okay. They're looking for inflation clues and looking to see, are the tariffs really impacting inflation, as Jerome Powell suggests that we need to wait and see if they are. Okay, well, here's the facts on now July's CPI. And remember, the tariffs Liberation Day was April the 2nd. So you've got now April, May, June, and all of July. You got 4 months of tariffs working through the systems. We know the positive side of tariffs and these trade deals bringing in not only now billions, but trillions. When you look at the EU investment and Japan's investment, you're talking about trillions of dollars that are non-inflationary dollars because we didn't have to print it. We actually made that money. So that's the good on tariff trade deals. The bad is the tax or the toll on the American consumer, which Jerome Powell suggests still now 4 months in, is coming. It's coming. It's coming. We need to wait. We need to wait. We need to wait. Well, July suggests it is actually lower than expected. Okay. Expectations for July were that this number, the all items increase, was going to come in at 2.8%. Well, over the last 12 months, all items increase is at 2.7%. So a tenth of a point lower than expectations. The June to July or the month over month increase came in at 0.2%. That was as expected. Month prior, month over month, it was a 0.3 increase. So 0.2 as expected, 2.7 under expectations. Now, if we take out the energy and food, so they call that core CPI, you see that actually moves up here to 3.1. That was expected at 3. So you have less than expected on all items. You have a little bit of a bump on less food and energy. Food and energy obviously can have a little bit more volatility there. And so when you go all items, less food and energy, core, little bit of an increase over expectation, a little bit of a decrease on all items, and you've got basically a wash there. Inflation still 4 months in now are not looking like they're having an impact. Tariffs now 4 months in, not having an impact on inflation yet. Potentially it'll come someday down the road. Hasn't happened yet, obviously. Let's take a look at shelter. And I agree with that headline on CNBC. I agree with Wall Street. Like, I don't trust any of this data coming from the government. I don't believe that the data is politicized. I think the government's incompetent, and the government's been incompetent for a long time. I believe much more in the private sector. And we're going to start looking at real-time data here on rentals from realtor.com in just a little bit. And to me, they're in the game. It's a company that is dealing with customers. They got to make money. They got to have the right technology. They've got a lot of traffic. Okay. I'll take, CoStar, Zillow, realtor.com data, Redfin data over the Bureau of Labor Statistics data any day of the week. The government's incompetent versus the private sector. Okay. They're average at best versus the private sector. You want to mess something up, go give it to the government. Okay. And so I've always had a problem with the government's, analysis on these reports. Okay. It's not a political thing. There's no incentive to be great like in the private sector. So shelter coming in and weighing at 35+% total of the CPI comes in at 3.7. Okay. So shelter is still carrying. If we go to, this is page 14 in the 38-page PDF here, but if we go right back to the top, they've copy and pasted this line for basically 3 years now as inflation has taken off. Remember, Jerome Powell called it transitory 3 years ago. He couldn't wrap his mind around, printing 80% of the US dollar. No, inflation's not going to really be a problem. It's transitory. He couldn't wrap his mind around that. The only way inflation exists is when the government prints money. And they've copy and pasted, they meaning the Bureau of Labor Statistics, which puts out this report. They've copy and pasted this line for basically 3 years now. The index for shelter rose blank this month, 0.2% in July, and was the primary factor in the all items monthly increase. The primary factor. If you remove shelter, or if you actually just utilize real-time data, okay, we're about to look at, hey, 35% Burns Consulting, 35% of markets are moving into the negatives, not the positive. You have rental data that has shown now multiple months and now going into multiple years of not inflating, not moving up. Okay. When you look at all that data and you say, man, if we just used real time data, not owner's equivalent rent, which owner's equivalent rent, if you can see your screen, I know it's a little bit small here, but owner's equivalent rent straight out of the BLS report is weighing 26% of CPI. This is not talking to CoStar and apartments.com and realtor.com and Zillow and you and your brokerage and MLSs and all that data on where the rental prices are going. This is talking to owners what they believe the equivalent rent they would have to pay of where they're currently living now. So just like everyday people who aren't in the game, who don't have really an idea because they're not doing it. And there's no reason they should know. It's why they consult professionals when they make those decisions. Okay, well, owner's equivalent rent makes up 26% of CPI. No wonder Wall Street doesn't have any faith in this government reporting. Okay. It's 4.1% up year over year, and owner's equivalent rent is up 0.3 month over month. Again, shelter moving up 0.2. So that's a little bit better than what we've seen in the past on the month over month increase. But if you look at shelter over the last 12, 3.7, well above the 2.7 for all items. If you pull shelter out, we're actually below the 2% on inflation. The 2% target, we'd be below it. We'd be talking about a totally different scenario here where they would have had to have started cutting months ago. Of course, they absolutely need to start cutting now. It is all but certain as the data sits here today, 82.5% chance CME Group suggests they will ease in September. Polymarket, so the betting line on this has September now at an 81% chance that there's a 25 basis point cut, 14% chance no cut, and 5% for 50. Rolling out to the October meeting, they've got 56% chance of an additional cut in October. So 81 and 56 on the side of cutting as Polymarket looking at it. Those numbers are up slightly from obviously where they were before the CPI report. So remember, you don't want to really, you're going to focus more on the jobs than you are on the inflation. Inflation has been moving down, and we want to use this as a scenario that we don't want, and we don't want inflation to get back out of control. But the only reason it did is because the government printed 80% of the US dollars in the beginning, and Jerome Powell doesn't want to be wrong twice. He was wrong in the beginning, calling it transitory. He doesn't want to be wrong here at the end and start cutting too soon. And so that's kind of what he's hedging against, his legacy, soft landing, trying to accomplish all of that at once. But we do see inflation moving in the right direction on the long run. It's super clear. I think there's a consensus now, and certainly CME Group, Polymarket has that consensus. It is now time to cut. We're not seeing the biggest impact tariffs and trade deals have made is money coming into the country that is non-inflationary. Okay. Inflationary is when you print money. Non-inflationary money is when you just go out and make it. Okay. And so we'll see if this actually pushes inflation up through consumers paying price. We've heard from national home builders and major companies that have suggested consumers are not yet paying the price. So will that remain true? Obviously, into the future. One thing that we do see that CPI is not necessarily acknowledging is this John Burns and Consulting data where home prices are now falling in 35% of the country. Okay. Resale prices, according to Burns Consulting, compared to 1 year ago in 53 of 150 markets that they track, are moving down. So the price declines are now spreading beyond just Texas and Florida, according to John Burns Consulting. New construction, new home prices, including builder concessions and incentives, have fallen 1.5% versus last year, as builders have caught with too many completed unsold homes for the first time in many years. Resale prices have risen in 65% of the country over the last year. For clients, they've got some more data there. All right. So these price drops that are spreading, let's go to just kind of where they sit on new homes. So this is new construction. The only two places new homes have now become, existing homes rather have become at a higher price than new homes. If you're a builder, you don't want to see that flip. New home price year over year, Northeast, Midwest, the only two regions where you're actually seeing new home prices move up. So this is just new homes, not existing. This is an independent survey of 16% of all new home sales with John Burns Research and Consulting here. And this is from June 25 to July 25. So you've got a recent sampling, big sample size, 16%, 3% and 2% respectively, Northeast, Midwest, on new home prices moving up. Everywhere else, Northwest flat, everywhere else in the negatives. Northern California down 5% on new homes, Florida down 4%, Southern California down 4%, Texas down 3% on these new home prices. And that's the price. Factor in the incentives where builders are stacking the offer to keep the comp price high. National average is down 1%. New homes, remember, have 10 months of inventory. So if you think this restrictive rate is good for the future of this economy, and in particular the housing sector, you got to second guess that. If these builders have to start laying off, layoffs of builders is always an early indicator of a recession. And so if we get to a place where the builders are like, you know what, we can't keep up anymore. We can't wait for the rates. It's a super rate sensitive environment. We just can't. Like you've seen here, early 2000s, like you see, obviously, in the great financial crisis, like you saw during COVID, recession follows. Okay. Now, obviously, COVID was a short one. We bounced right back. And obviously, the market took off from there. But you are seeing now this decline in residential specialty trade contractors, residential employees. And if this decline continues, it's one of those indicators in the past that suggests economic recession. It spreads throughout an economy when you're playing with fire, as the Fed currently is with the current interest rate. Okay. Now, listen, I don't think anybody should listen to the administration and cut 3 points off of the federal funds target. But I think 25 basis points at this point, there's enough data to back that up. The only time they cut was leading into an election. So this whole debate is, hey, are some of the stats political? Is the Fed being political? Well, when you look at that, when the only two times the Fed has cut was September, and those two cuts were leading into that November election, that presidential election. It's curious timing for sure. And there hasn't been a cut since. There's more data today that would suggest it's time for a cut than there was, obviously. Then I think they should have cut then, and I think they should be cutting now. Okay. Jobs, according to this report, and are underpacing rather. Job creation is underpacing new home construction. New homes, again, sit at 10 months of inventory. This is a recipe for disaster for new home builders. Everybody that says, We are 7 million homes short to meet demand. Baloney, we are. Look, just talk to the national home builders, how much inventory they're sitting on, and they're sitting on all the inventory here, okay, where resale price appreciation, new home price appreciation is moving down, not up. The only places you have significant home price growth right now is the Northeast, where builders don't build. Okay, they don't build there for a couple high regulation and the migration patterns moving out. Okay, the migration patterns moving out have slowed down, but if you look in the last 10 years, they're obvious, right? And so national home builders have projected out in the future that will continue. Whether it will or not remains to be seen. And the pricing in the Northeast certainly makes it more restrictive for builders as well. But the regulation of building in the Northeast has just made it unpalatable for builders. And you see them building in these Sunbelt states, and you've got an increase of inventory there. And that's where you see prices going down. If you're sitting on 10 months of inventory, you can't tell me we're 7 million homes short to meet demand. We're geographically short. And in terms of affordability, we're short. Okay. But one thing that can help with affordability would be the obvious move of getting rates in alignment with where they should be today. All right. If we want to look at more real-time data to suggest how off that CPI report on housing is, let's do that. Let's take a look at realtor.com. Okay. Realtor.com gives us actual data in the moment, not 2 years lagging data. That is a survey from homeowners. Okay. Rents have declined again. Rent nationwide, 2.7% below the 2022 peak. Okay. So from the 2022 peak, rent has been on a consistent decline. Rent is not on a consistent inflation. Inflation does not mean that prices move down. The 2% target of inflation that we have as a mandate for the Fed, Congress has a mandate, maximize employment, 2% inflation. 2% inflation means that prices go up forever and always. Trying to get inflation down to 2%. They're not trying to revisit 2019 prices. Okay, whatever milk cost in 2019 is never coming back. Whatever insurance cost in 2019 is never coming back. 2019 price is, the price level is over. The government printed 80% of the US dollars in circulation. Those prices are over. What they're trying to do is the rate that the prices will go up forever and always. They're trying to cap that rate at about 2% a year so that the consumer doesn't feel it. Okay? That's the whole game here. Now, what's going on with rents is that they're actually moving down. They're deflating. Okay? Now, the price category, the new level of rent, yeah, it's not going back to 2017. Okay, this red number here, the asking rent, it's not going from, call it just under $1,700. It's not going from there to $1,000 on the median asking rent. Once a landlord's like, dude, I'm getting $1,700 a month, they're not all of a sudden moving to $1,000. Now, you are seeing areas where they overbuilt. Tampa, or you've got Austin, Texas. You are seeing more incentives from developers and some cooling off of the price, but it's not a swing of like one day it's $1,700 and now it's going to be $800. That's not happening. The median asking rent set a new level, broke a new level, and it's going to kind of sit there or 2% below the 2022 peak for the foreseeable future until you actually have the next increase. as we look at how you would measure inflation, well, it's doing the opposite. It's moving in the negatives. The year-over-year change is in the negatives. Okay. You've got 24 consecutive months of year-over-year declines. CPI doesn't reflect any of this. The U.S. median rent was 2.7% below that peak. It's 18.6% higher than the same time in 2019. We're not getting back to 2019 levels. You know, if you, hey, everybody listening to this probably has all their teeth. If you still believe in the tooth fairy, I don't know, go rip out a tooth and put it under your pillow and see if it happens. We're not going back to 2019. Those days are over. All units saw rent declines. Studio, 1 bedroom, and 2 bedroom, all seeing rent declines here in real time, not made up Bureau of Labor Statistics lagging data of 2 years ago. National rents by size, you've got overall at 1,700, 2.5% down year over year. Consecutive months of a decline, 24. Studio, 1,428, down 1.4% year over year, 23 consecutive months of a decline. 1 bedroom, 1,590, 2.8% down year over year on the rent price, and 26 months of a decline. 2 bedroom, just under 1,900, 2.3% down on price, and 26 months of a decline. Remember what we looked at. Page 1, Bureau of Labor Statistics. The index for shelter rose in July. No, it didn't. Remember, when they take July's data, Jerome Powell has said this multiple times in the Q&A, well, our data is 2 years lagging. So when you read this and it says July, no, the data that you guys have late in the game, way late, that shows up in how you report Bureau of Labor Statistics in July suggests a 0.2% increase. Well, their late, outdated data is the primary factor for inflation moving up. Not tariffs, not the toll booths, which tariffs are a toll booth. They're a tax on cost of goods sold. Cost of goods sold. That's a number pretty far away from the consumer. It's not. It's shelter, and it's because they have outdated data. And if they had a true number here on the inflation, they would have been cutting, not just in September and November leading into the election, but they would have continued to cut leading in today. They meaning the FOMC. Obviously, there's a lot of support for that. Here are some markets with some trends where they're moving away from the building. I talk about those highly competitive markets, which are seeing bigger swings. Orlando, okay, you're seeing a lot less permits today to go build multifamily. Philly, San Antonio, Charlotte, Las Vegas, okay, they're all moving away from building in this type of environment where they're seeing rents actively moving down now for multiple years. Okay. Atlanta's 4.3% down. Austin, where they've built a lot, is bigger than the national at 5.3% down. The median asking rent in Austin is $1,400, $1,460. Austin's very affordable. If you're, looking for affordable cities, Austin's probably done it better than most. Baltimore, which is over 1,800, is only down 0.1% year over year. Let's just look at some. Chicago's down 2.4% year over year, now under 1,800 a month. Cincinnati's down 4.4%. Denver's down 7.7% year over year. Jacksonville's down 4.3%. They've built a lot of multi there. Houston's down 3.6%. LA's down 3.2%. Vegas is down 2.9%. Minneapolis down 2.6%. Nashville down 3.7%. Look at Phoenix down 5.4%. Portland's down 4.5%. Raleigh is down 4.6%. San Diego's down 6.6%. Obviously, San Diego very expensive, $2,700 on the median. Tampa's down 0.2%, $1,700. And there you go. So there's your real-time data. Very much a different story than what the CPI is suggesting. And so 10-year, you know what the 10-year did today? Remember, we want the 10-year and the 30-year fixed to move down. Now, a good, strong inflation report actually didn't help us. And we know the jobs impact this number way more because the jobs suggest that Powell will be forced into making a cut. The CME and Polymarket still believes that he will. Still, 4.3 is a decent number in respect to where we've been in the last 30 days, still trending on the lower side of the last 30. It did see yesterday the 30-year move to 6.58 rather, and might bump up a little bit here today. All right. There you go. There's your hot sheet for the day. If you want to get access to all of the slides that I use right here, just go into Classroom on School. I got to just make sure that I am logged in here, which I'm not. Go to the Classroom on School for BAMX members. If you haven't signed up, this is how you sign up right here. Go to Classroom, jump into the hot sheet, and just click on today. All the slides used today are in for, and look at shelter even as it relates to CPI. It is trending down. If they got a hold of some real-time data, this number would be closer to the line here, the zero line. Unbelievable the way they're tracking this stuff. All the slides used right here are in, as well as the hot sheet show notes. Go to school.com/BAMX. Saturday, if you're looking for not only just a cool event, but a masterclass on how to pitch a product, join myself, Eric the Broke Agent, Sharon Srivatsa, BAM board member, in supporting the $100 million Money Models book launch. Alex Hormozi, friend of BAM, has his book launch happening Saturday, 9 a.m. Pacific, 12 p.m. Eastern time. We've got the link down below. That link, Haley, came up so fast. I've never seen a link come up faster than that one there today. So Haley's an unbelievable with this link here, the book link. Great job, Haley. Haley, I had somebody in the replay yesterday said, take it easy on Haley. Was I too hard on you yesterday, Haley?
Never.
Wow. That's a one-word answer. Maybe there's more. I'll find out if there's more to that story, but Haley's usually pretty truthful. $100 million Money Models, links down below. It's a free event. I mean, you don't even have to buy the book. That's the thing. Like, if you want to buy the book, read the book, who cares? The event will be a masterclass on positioning product. So anyways, that's down below. Hope everybody has a great day. We'll have a real word pod up later today. Until then, of course, toodaloo.